There has been no shortage of concerning headlines this year, from tariffs and trade to the big beautiful bill, all the politics behind it. But beyond the noise, equity markets continuing to hit new highs. And it's not just about tech. Other sectors are playing along, so what is going on? Benjamin Gossick, Managing Director and Co-Head of Global Equity Portfolio Management at TD Asset Management, has some ideas for us. Great to have you back on the show, Ben.
Thanks for having me back. I know it's been a while, but you're bringing a ton of energy. I just want to match it, hopefully walk people through some of the opportunities that we're seeing out there.
By the end of the conversation, they will not be able to restrain us. So let's get going here on it. First, what's your sense of what's happening there? I know you always bring the charts. We love the charts. You got a chart to help us make sense of what's happening in the markets right now.
Yeah, I mean, for the faithful viewers that watch your show, Greg, many of these charts are not going to be new or novel. I do have one new novel chart, although it's an oldie. But the trends continue. And so, yes, we have an S&P 500 at new all-time highs, TSX 60 around that level. We could look at the German DAX. We could look at China. We could look at Japan. Equities have been doing very well. But yet when I open a newspaper, when I look on my phone, when I look on TV, when I talk to people, funny, there's still a lot of stress out there.
A lot of stress. So let's pull up that first chart and walk us through it and see what the picture is telling us. Will tariffs negatively impact Canada?
Yeah, so I mean, clearly this has come up all throughout this year. Even now, people are already starting to queue up to, what does future USMCA talks look like? Again, the faithful viewer knows I really like to look at relative strength and weakness. I look at this as a tug of war between the market. On the top of this chart are the equal weight Canadian banks. And coincidentally, they've all finished reporting earnings, and they've been great. And the denominator is the TSX 60. And so what you can see when I look at this, they've been on trend since November of 2023. And we have gone through multiple rounds, even starting as early in February, in terms of tariff threats from the US and impacts on softwood lumber, aluminum, steel, a whole host of items and autos. And for me, the canary in the coal mine for Canada and the Canadian stock market in particular are the Canadian banks. We've seen in the past when oil cratered, and the banks have been on an upward trajectory, and I'd say the majority of banks saw positive reactions to what I thought was a really good quarter. And to be up 5, you think, oh wow, this is new news. There must be something going on. But when you put it, when you put banks on top of a denominator, it looks like the continuation of an existing trend.
Okay, so that's a great one. Let's look at another chart now. This one, I think, plays off that theme that this idea there that people are selling the U.S. and they're buying Europe. What does this chart tell us in terms of what is actually happening?
Yes, I'm sure you've had countless shows talking about the end of U.S. exceptionalism. Should we look elsewhere? And conveniently, continents like Europe were looking incredible. What people are looking at here is a tug of war of the S&P 500 versus an ETF that tracks the world developed equity markets ex the US. So US versus rest of world. And they see an upward rising chart, which means the US has been dominating the rest of the world. If you were to evaluate a global mutual fund or ETF, you typically find 70 to 80% US content. A lot of that can be explained by a chart like this. Having said that, there are periods where the Europe has had advantage over the US. We saw it in the sell-off in 2022. That's what we've circled there. And obviously, most recently, we've seen the S&P sort of lag, and we saw Europe take off. And everyone started to tell people that you have to focus on international funds and fund it from US funds. And I'm going to show a couple of charts, but this is not a new trade. And also, it won't be long that people will start telling you the other thing, which is, you know what? US exceptionalism is tarnished, but it's okay. Let's bring the money back. And if this is how you're investing, you may be successful at it, but it's very challenging because you're constantly flowing money. 2 years ago, we would have been talking about Japan. So we're just throwing money all the way around, and we're never knowing where it's supposed to go.
So that chart, I think, leads nicely into this next one. We asked the question, should investors be buying Europe right now? Or should we buy Europe? What's this one telling us?
So the answer is Europe's great, but we don't have to own the entire continent. What people were discovering but didn't know, they thought Europe was a 2025 thing, and it must have started this year. And that's why everyone's excited by it. What people are looking at right now are the European financials over the EFI index. This is the broad international index. And what they can see is that European banks and insurance companies and asset managers and indices, the companies that own the indices, have been outperforming since at least 2020. So we're talking about a 5-year trade, not something that is a 2025 story. So yes, when they were buying EFI and Europe, they were picking up on this, but they thought this was new and novel. The new trade is the old trade, Greg.
Let's talk tech, because obviously a lot of criticism of the market rally we've had and propelled the new highs is that it's a concentration in just a handful of names, and then that gets people worried that if those names don't deliver, the reason why we're watching NVIDIA so carefully, that we're in a lot of trouble. Has it run its course? Are we back? What's going on?
Okay, so perfect setup. What we're looking at here is the XLK ETF. This is the tech stocks of the S&P 500 divided by the S&P 500. What I want everyone to highlight is that this had a peak in August of last year. You know, summer's almost over, but I am very nostalgic to when these stocks all peaked. And I'm talking about NVIDIA and Microsoft, Apple, Brock, like a whole host of large cap tech stocks peaked in last year and basically underperformed the S&P 500 for almost 10 straight months. There was a bottom you can see at that blue line, which was a level of support about a month to 2 months ago. And then as we've gone through earnings seasons, we've seen great results from most of these companies, and that has confirmed that that was a bottom and we're now lifting off again. So this is what I believe now tech was an underperformer for 10 months. We're just 2 or 3 months into this new run of technology. Again, going to be driven by AI and a whole host of issues. And not every tech stock is participating in this. Most software stocks are dealing with an existential crisis about will AI impact their terminal value. But a lot of this is going to be driven by semiconductors, hardware companies, could be hard disk drives, fiber optic cabling. But if tech's back, then that's a good sign for the S&P 500. And this is why I do think money will probably you'll be told to flow your money from Europe back to the U.S.
Okay, last one here is home builders. Obviously, a lot of eyes on the our housing market here at home, but the U.S. housing market in terms of being a bit of a laggard. What's going on there?
So in 2023, I would have been on your show, Greg. We would have been talking about home builders, and they seem to be doing well, and all we're doing is talking about a looming recession. And that's that run-up that people see kind of in 22 into 23, and then it peaks late last year. And so even as interest rates went from 0 to 5% and mortgage rates in the US were at 8%, home builders, and we're not just talking about the companies that physically make the homes, insulation companies, garage door opener companies, the mattress companies are all part of that index. And then it's very possible, I don't have confirmation, that elevated interest rates took a bite into that trade, and that's why we saw the sell-off. This is, I do believe, seeing green shoots. I'm not advocating for people to go out there and just buy home builders just because I showed you a chart. What I'm trying to say is we have financials in Canada, US, Europe, Japan, China, all do very well. That's very positive for our stock market. We have industrials in Canada, US, Europe, Japan, China, also doing well. That's cyclical, that's very supportive. And in another area that was an early cyclical, that had worked, that had waned, and now coming back, again, I think is very positive for the stock markets. And I know people do get very stressed when they see stock markets at elevated levels. And that stress is probably the fear that they're not participating. Or if they did, they may lose whatever money they've made. So again, a chart does not create a thesis, Greg. But it is helpful to see a whole host of various factors that we look at all pointing in a positive direction.